I'm really going to talk about two things. One is I'm going to give you a bit of an update on the transformation of the asset management industry, where we are, where we're going, the progress we've made, and also some of the things that may come from a regulatory perspective. Just to get an indication of the audience, are any of you trustees on institutional funds or advisors to institutional funds? Or principal officers, quite right. Okay, all right. So I see there's a lot of learning to be done. And then the second component that I'm going to talk about is going to be the OBI score. You've heard a lot about outcomes-based investing, and I'm going to talk a little bit about how the outcomes-based investment score works, and I'll give you some real-life examples of some of the things that we've done with it. Okay, so if we look at the asset management industry in South Africa, you can see it comes to approximately 5 trillion rand of available private sector investment assets. Probably about just under 9 billion in total, but a big chunk of that's managed by the PIC. So if we look at what's available on the far right-hand side there, you can see that the largest 10 asset managers manage about 71% of the total assets. Now you can kind of imagine who those are. You know, the old FICA asset managers come in. If you don't know who FICA is, the Forward Investec, Coronation, Allan Gray. They form a big chunk of that. The next 10 asset managers make up the next 20%, and then the rest of the asset managers comprise the final 9%. If we then look at the asset management, the black asset management space, and here we're typically talking about asset managers that manage more, that have black shareholding of probably more than 51%, we're sitting at around about 10%. A number of years ago, that was about 6%, but it depends on whether you include the total investable assets in South Africa or those only available to the private sector investment managers. So clearly, a number of years into, 25 years into democracy, we haven't fared particularly well. If we look at this, let's have a look at the difference over here. The difference between 2013 and 2018. So end of 2018, probably it is a 5-year analysis. If we look at the number of black asset managers, the number have pretty much doubled. So there is the creation of a lot of those asset managers. The assets under management increasing from about 250 billion to just under 500 billion. Now you can make a certain amount of allowance for market growth, so that's not all new money, but you've roughly doubled the number, and certainly probably a big chunk of that is due to increased allocation to black asset managers. But certainly over the last 5 years, one wouldn't really call that success in terms of transformation. Largest one particular asset manager continues to comprise about 30% of total assets managed by black asset managers. And that's a manager called Quanta. And then if we look at the allocation, what is pleasing to see here is that the largest 10 largest black asset managers now manage 84% of the assets managed by black managers rather than 94%. So what we're seeing there is that we're certainly seeing an increase in the number of black managers and the diversification across them. The problem that we're seeing is they're kind of eating from each other in the same pie. The pie in the black asset management space is not growing, or it's not growing substantially. What we can see, who the managers that are benefiting over the last couple of years, those have grown by more than 20%. These are managers that you may or may not know. Perpetua, that's Delphine Governor, ex-Allan Gray. You've got Sentio, Sesfikile, Eon, and then Mazi Capital, Mazi's Malungelo Zulumbolo. And then those who've struggled a little bit over the last couple of years are those managers over there. Fundamentally as a function of performance reasons. So what we're seeing is transformation doesn't only happen with new asset managers coming into the market, black-owned asset managers. You can also transform the existing managers, so your old FICA. So we had a look at those, and we looked at the largest 10. And what we can see is from a BE scorecard perspective, very few of those asset managers, you take the Coronation, Investec, Allan Gray, this from a scorecard perspective, there were very few changes. There may have been one movement from a level 3 to a level 2, but we haven't really seen managers moving from a level 5 to a level 1. That's not really happening. What we are seeing, the other thing I want to mention here is the black shareholding changes. The only manager that I can think of where there was substantial change in the black manager shareholding was Coronation. Went from about 20% to 32%. Surprisingly, Coronation gets most of the flack around transformation for being slow in terms of the pace. And I think a lot of that has to do with their own messaging. What we are seeing, we're seeing some improvement in the transformation of the asset management teams and the actual investment specialists, but it certainly isn't happening to the extent that we'd like. So why is this change happening so slowly? And I've been an investment advisor for more than, I suppose, just on 20 years. So I've got a lot of experience engaging with funds around this. And so a lot of the questions come out, is it because there's a lack of support from trustees? The short answer to that is no. I can probably think of one example of all the funds that I've had in my period where they said, we're not into this transformation stuff. It's not our game. Is a lack of confidence in BE asset managers. Maybe initially, but certainly not. You can go and look at any of the surveys, compare the traditional white-owned businesses with the black businesses. You get good managers, you get bad managers. It's certainly no reason to discount the space. And overwhelmingly better performance from the white-owned managers? No, not at all. Okay, so what are some of the reasons that we see for the slow change? A lot of this is really, we heard about investor psychology. A lot of this is about the psychology that the trustee has when making a decision around appointing asset managers. A lot of folks is they don't have the time, the confidence or the expertise to do it. So quite often you'll see a trustee board, they meet once a quarter, they've got a whole range of matters that they have to address, from doing an admin report, understanding the employee benefit matters, rebroking risk, looking at their investment performance, and they've generally got about 3 hours to do this. In addition, many of them may not necessarily be investment experts, so they certainly struggle from an expertise perspective. Certainly the large funds, you take the Telcoms, the Escoms, the De Beers, many of the funds in excess of a couple of billion managed to do this very successfully. And I'm going to use Eskom, the EPPF, as an example just now, because they really are at the pinnacle of transformation and the way they manage their funds. Notwithstanding the difficulties the companies faced, the fund is exceptionally well run. Personal risk, nobody ever got fired for appointing Alan Gray. You appoint Joe Soap and it goes wrong, you're in for the high jump. Sustainability of new managers, that's without question a reality. We know that new businesses fail. New businesses fail all the time. So now you're also entrusted with the monies of your members, and quite often that's, let's let them build for a while. Let's give them 5-year track record, a 3-year track record. Once they've done that, then we'll allocate monies. That's not helping matters. It is a sensible and a reasonable view, but it actually needs to go a little bit deeper than that. And then we're talking about, there have been some questionable manager dealings, especially with respect to the PIC. And I think a lot of these things are just used as an excuse because it's difficult to do. I don't think people don't want to do it, but they're often finding reasons, let's just stay where we are. Which is the point that one of the speakers earlier made. I don't know, maybe we must feed them. Maybe they make better decisions once they've eaten. You certainly shouldn't go and try and select asset managers at the end of the day. This is another one. Many small managers make funding governance more complicated. I don't think that's worded very well, but the more managers you have, the more complex is your strategy, and it impacts things like your investment administration. So that complicates matters. And one of the things that's often forgotten about is that, second from the top there, the cost implication. So you can imagine you take 200 million away from a Coronation, who you've had for 15 years. The fee for Coronation is 50 basis points. You spread that 3 ways between new managers, so they've all got smaller portions. Because it's less assets, they should charge 60 basis points. All of a sudden, you've increased the cost to your members by 10 basis points. And that's a problem that people are struggling to. So you could go to the new managers and allocate it 50 basis points as well, but those guys are struggling to survive. You don't want to, I wasn't going to use the word screw them on the price, but you know what I mean. And then the other thing is, what we traditionally find is trustees are setting incubation portfolios. So they'll take like 10% of the fund and then they'll split that. Now, if you think about the rand values, once you've converted that to fees, it really doesn't make much of a difference at all. So it's appreciated, but it doesn't really get to the point of addressing the matter. Okay, so moving forward, without question, this is something that needs to be done. 25 years in, for us to have less than 10% of assets managed by black asset managers in South Africa is shameful. We understand why we got there, and there's good reason why we are where we are, but there's certainly perfectly sufficient good black asset managers out there to get consideration. So I think what we're saying, a couple of things. Investigate this with intent. Set aside time specifically. It's very difficult to go and redesign your strategy, appoint new managers with a different slant if you're going to try and slot it into a 3-hour trustee meeting along with all the other things that you're going to have to do. It just doesn't happen, and you say, we'll do it next quarter, we'll do it next quarter, we'll do it next quarter. Take advantage of experts where necessary. We know what we're doing. We've been around. But there are different ways of doing this. There are different ways that you can implement it. The one approach that you can apply is the DIY. So it's do it yourself. That's where you as a board of trustees go out and you select asset managers. You do the dog and pony show. You get to see the asset manager, who's there, how do they operate, and then you select them. That's quite an onerous process. And without question, you should get advice around doing that because the consultants know who you're talking about. The other ones that you buy a pre-constructed product. And that's where you go to a provider and you say, I'm looking for an equity portfolio that has a black asset manager flavor to it. Show me what you've got. Let me see what you've got. Who are the managers, etc. And then you can do a combination of the two. And that's pretty much what Eskom has done. Now, Eskom's a 150 billion rand fund, I think, at last count. They've allocated about 20% to black asset managers. And the way they've done it, they've used an investment platform because a lot of the complexity comes around the admin. So hiring managers, firing managers, operational due diligence, who's managing the soundness of those asset managers. And then as you have cash flows moving backwards and forwards, that's exactly what they do. So EPPF will go and appoint those managers, and then they'll go and get it facilitated through the investment platform. And investment platforms play a very big role. And then I just want to finish off on something that you'll see the amended financial sector services sector code from 2017. There was an announcement made that the largest 100 funds are going to voluntarily demonstrate their scorecards. Now, if they don't voluntarily do it, it may become less voluntary. And the point that we're making here is it going to stop at the top 100? I don't think so. And to be perfectly honest, in this country, I'm not convinced that it should. There are really exceptional managers out there, and they need to be given consideration. So maybe that's something to bear in mind for your next meeting, for your next trustee meeting, as you're engaging with your investors and your service providers. Something to bear in mind. Okay, so now the second thing that I'm going to talk about is building investment strategies on an outcomes-based investment approach. Now, by show of hands, who of you in this room have a scorecard, a performance scorecard that your employer gives you so that you know what you perform, how to perform? Okay, well, I do. Okay, so scorecards are not something new. Now, one of the things that's incredible about a scorecard is the first time you get given that scorecard, now let's assume you don't really know what you're supposed to do. You look at that scorecard and all of a sudden you know exactly what you need to do. It's very clear. And you look and you say, if I do this, there's a 50% allocation. Okay, that's an important one. The one with the 3% at the bottom, maybe that's not so important. I can't ignore it, but it's not so important. Now, one of the things about the outcomes-based investment score, it's very much like a scorecard. Now, there are many businesses that you see, everybody's working, they're doing the best that they can, they carry on, they're squirreling away, and yet there's no real scorecard that they have. And that's how we almost see traditional asset management. You're looking for a return, you go to the market, and you do the best that you can, but you don't really know what to achieve. So let's have a look at some of the ways that we look at investment performance at the moment, the traditional way. And this is something you can test me on this. You can go to any investment performance report that you've seen. You can look at any survey. How do they look at performance? You see the 1 year, the 3 year, the 5 year numbers. Okay? And these are just shown on the graphs. And then I'll come to the risk numbers now. One of the problems with that, the drawdowns, is has anybody ever had money invested with Alan Gray? Okay, I have. My clients have, and my personal capacity. Alan Gray is a perfect example, as is Orbis, as is Contrarius, because the performance can be very volatile. And what you can see is you can have 2 or 3 months of exceptional performance. Have you ever seen that? Where Alan Gray, you were sitting thinking, we've got to get rid of this manager. They're useless. I mean, we know they're not useless, but the performance isn't there. And then all of a sudden they shoot the lights out. And not only do they do well on the 1 year, but the performance is so good that it drags through to the 3 year, the 5 year, and since inception. And over a 3-year period, they've gone from being the worst manager in the survey to the best over all periods. I mean, how does that happen? And a lot of this is because of the bias that you allocate to the most recent performance. And then the only risk we really look at is the volatility, and we typically look at volatility over 3 years. So what we're saying in the outcomes-based investment score, and this is just a little test, and I'm going to a little tidbit, and then I'm going to come back to a little bit later. When you look at the outcomes-based investment score, any period that we look at, we're looking at rolling periods. So we're eliminating the bias of the short-term period, and we do exactly the same thing on the risk. I'm going to talk a little bit about risk later, because we don't, in the outcomes-based investment score, you don't look at risk as volatility. You look at risk as the client experience, but I'll explain that just now. So how do we use the outcomes-based investment score? And how do we use it when we're building an investment strategy? Now, the typical way of doing it in an institutional fund is you determine a CPI plus objective. So, for example, in an accumulation phase, so that's the aggressive portfolio, we want to achieve inflation plus 5. What do? You go to the propeller heads and you say run some stochastic asset modeling, and what they do is they come out with a strategic asset allocation. Let's ignore this for now. And then once you've got the strategic asset allocation, you go and you implement the portfolio, you invest in various asset strategies, you select asset managers, and then you assess the performance. The difference here is in the outcomes-based investment approach is you set a risk budget. Now, that's not a term that is necessarily new. In fact, it's not new at all. But until I arrived at Momentum, I'd never seen those words converted into maths. It was always a risk budget, and it was always this thing that's out there. We got a risk budget. Okay, but what does it mean? But Momentum, through this thing, we've created a risk budget, and we can convert that from the words into maths, and I'll show you how we do that just now. It really is understanding of what you're trying to achieve, what type of return do you want, and what is the type of journey that you want. And then you follow the same approach as before, but then you have a look at the OBI score, the outcomes-based investment score. Okay, so what is it and how does it work? So this little infographic, if you have a look here, it's split up into 3 components really. And the outer ring is called the hit rate. Also very, very easy. How many times did you achieve the objective over a certain period? Okay, in this example, the hit rate's 95%. So we achieved inflation plus 5, 95% of the time using a specified period. So for example, if you're targeting inflation plus 5, you won't use a 2-year period. You look at a 5-year period or a longer period. The next thing we look at is the risk. And there you can see that's in 1. So the risk there is 31. And risk, as I mentioned a little bit earlier, is not volatility. Nothing wrong with volatility, and you can use it differently, and you can run it almost in parallel of this. But it's things like the risk of capital loss, the severity of loss, and the probability of loss. Now, that's a very, very different way of looking at risk from before. What we can see from that is the risk is 31. It doesn't matter what the numbers are in this case. And then the final thing, which is kind of the big number, is the OBI score, which is a combination of the two. And so depending on the nature of the portfolio, if it's an aggressive portfolio, we place more emphasis on the hit rate. And if it's a more conservative portfolio, we place more emphasis on the journey. We don't really have time to go into in a lot of detail, but it's fairly self-explanatory. So that number of 89, it's not a percent, it's a number, and it's always relative to something else. So a number of 89, is it good, is it bad? Well, we don't know, but we'll show you now. Where does it get to? So how do we then use it in a fund? So the first thing we do, you'll remember that those slides I showed you with how you put a portfolio together. You follow that approach and you come out with a strategic asset allocation, which is effectively at the moment you would call it your market benchmark. And for fund XYZ, and this is a real fund, if you look at the performance of the benchmark over time, you can see there's the hit rate, the benchmark achieved the objective 90% of the time, the risk was 45, and you ended up with an OBI score of 87. Okay, that's good because that's your benchmark. Then you say, okay, well, what was the actual experience of the fund? Any difference between here and there is as a consequence of decisions the trustees make. Did we invest in active or passive? Did we apply different asset strategies like hedge funds, like private equity? Did we invest in global? Did we invest in smart beta? Whatever the case is this number better than that number? If that number's worse, then we've detracted value. If the number's better, we've added value. But what you can see from here is everything we've implemented, we've made a difference, and we've looking at the hit rate and we're looking at the risk. And then, so immediately there you can see, did we do better or did we add value over the benchmark? And the other thing that you can then look at, and I really, really, really dislike looking at the peer group because it's completely irrelevant, but it does have a place in terms of adding context to some portfolios. If you do terribly, sometimes it does make sense to go and say, well, did everybody do terribly? If we underperformed our benchmark, but everybody's doing terribly, okay, well, maybe there's reasons. There's no reason to go and make substantial changes to the portfolio. So this is how we've run this on numerous funds, and been exceptionally interesting to see the reaction that we've had from portfolios and from trustees as they've understood the implications of the OBI score. So what we then did, and this is a real-life example, and let's just focus on these numbers here. These are real asset managers. You can see taken from the Alexander Forbes Large Manager Watch, and these are the major, largest 8 managers. And I'm not going to go into the detail. This does provide the detail, but I'm not going to go into that. I'm going to only focus on this graph here. So this is the best investment view. You'll see that's 10-year returns, 10 years worth of data to the end of February, and you can see how some managers have performed relative to others. What I will tell you, because I don't really want to get into the names, because otherwise we'll spend all day going, ooh, what? But this manager, that's Alan Gray. Okay, it's probably not particularly surprising. And this manager down there is 8. It's a manager that begins with an S, and it's not Sanlam. The other thing that I want to mention here is look at the difference. Manager 3 is Prudential. That's their global balanced portfolio. That's a Prudential local-only portfolio. So you can immediately see, look at the benefit that pure diversification has. So there's many things that one can determine from this around the benefits of the OBI score. But one of the things that you can absolutely see there, it's crystal clear, the benefit that having diversification of global portfolios in a portfolio. And so at the outset, through a very, very simple tool called the OBI score, you get much richer data than you would get purely from this is the return over 1, 3, 5 years and the volatility. So then in summary, you've heard a lot today about diversification. You've heard a lot about managing costs. We've heard a lot about investor behavior. We've heard the investment asset performance is likely to be muted in the next while. So what are some of the things that we can leave you with? Probably the most, and this is not rocket science. If you think about anything in your life, spend time on the strategy. I know we always want to dive in and we want to get involved in the tactic. The strategy is really important. Spend time on it. Focus on what you want to achieve. Apply your mind to think about it. It sounds like a bit of an odd thing to say, but you'd be surprised in my years how people haven't really focused on what exactly is it you want to achieve? What is the type of return? What is the type of behavior that you expected from it? So that 3 years down the line, because something always goes wrong, you can go back and say, hang on, remember we did this. This is what it looked like. This is why we did it. Guys because when we panic, we make bad decisions. If you remember nothing else from what I've said today, think about the risk budget. We'd love to come and show you how it works. It's an incredible tool in converting words to maths. It's an incredible tool. Measure the right thing. Again, I've spoken a lot about the OBI score and measuring the journey. Don't get distracted. And then the final one is stay invested. There was the behavioral scientist, Greg, spoke a lot about that as well. Staying invested, stay the course of time. That's the first time that I've seen that, the red and the green. I've seen it slightly different in investment pyramids, but there's an incredible tool to show you the benefit of staying invested. It would be interesting to see how those what did he call it, his line of influence or whatever it was, how it would change through time depending on different markets. But these are the really key things to be aware of. So I'm out of time, and I'm just going to ask Letsejo to come and close out for us. Thanks very much.